And then the final speaker in this trio is Andrew Hollingworth of Holland Advisors, who set up Holland Advisors in 2009. And Holland is a research firm, and he is going to talk to us about on this subject, which will mean a lot to everybody in the UK, and probably something to most people not in the UK, but he'll tell us about it.
Well, it's sort of time for fancy dress, isn't it, really? Is that for water? I think it must be. Good afternoon, everybody. You've had some good presentations from some wise investors. This is the graveyard slot. It's the last slot you've got from an investor before we close the investment presentations. So I'm just going to give you a light-hearted look at the world of football, but also possibly just a little bit at the world of investments as well. But before we do that, we've got a couple of prizes, well, not prizes, sort of gifts, if you like. So I'll have one of those. That's good. So David, are you around somewhere? Where's David Shapiro? Is he in the audience? One of those is for you, sir. Well done for all of your hard work today.
Very kind, thank you.
And one of those is for you, David. And Robert Hunter, are you around somewhere, Robert, or are you up in the gods? Well, anyway, we've got one for Robert as well, so we'll pass that out later on. So why the football reference? Truth be told, it's not a football reference. It's a Leicester City reference, as you can tell by the shirt that I'm wearing. 3 years ago, I did a presentation on this very stage, and we talked about a Leicester City portfolio beating a Manchester City portfolio, Manchester United portfolio at the time. Why did I pick that title at the time? Because Leicester City had just won the Premier League. Now, it's really important for you to understand, you're here at an investment conference, but it's really important for you to understand how difficult that was for them to do. Okay? In 2013, Leicester City got promoted back to the Premier League, having spent 10 years out of the Premier League. Okay? In December 2014, Leicester City were bottom of the Premier League. Had a new manager that summer. By December 2015, remarkably, Leicester City were top of the league, but no one thought it would last. In fact, nobody thought it would last so much that Gary Lineker, football pundit, Match of the Day host, national icon, and so on, said, and I should add, lifelong Leicester supporter, said, if Leicester City win the league, I will do Match of the Day in my underpants. Well, as the saying goes, be careful what you wish for, Gary. So here's Gary, true to his word, the following September. So before we revisit the portfolio we looked at in 2016 and look at any learnings we've got from that, let's just do a little bit of an advertisement. So if you want to check your phones or you want to check share prices or have a doze, now is the time. So just a little bit quick advertisement of what we do. Holland Advisors is a business that I set up in 2009. Mark Power is over there as a brilliant analyst who does things other than hand out footballs occasionally. Mark works with me. We do two things. We provide investment research to the institutional fund management community. We still do that despite MiFID. It is tougher post-MiFID, but we're very grateful for the support we get from our fund managers, and we're very proud of the investment research that we do. We also run a small investment fund, which has been a private investment fund up to now, but we are looking at making that a UCITS fund later this summer. So as a consequence of which, if you're a family office in the building, or if you're an investment trust looking for a new manager, come and see us. Separately, if you're a fund manager who's a little bit short of investment ideas, come and see us. And if you're an intermediary or an end customer, well, maybe we might have something for you by the end of the summer as well. Okay. Actually, just before we're going to go on to that, in terms of how we think and what we look for in investing, I've talked to this subject a number of times before, but I think this is an absolutely fantastic quote. So I'll give you a minute just to read through that. And for those of you who've seen me present before, this slide is always on every presentation I ever do, and I make absolutely no apologies for that. The reason being is I think it takes a long time to know what you're looking for in investing. What do we look for? We look for great companies run by great managers, but we're interested in buying them when they're trading at great prices. And if we get all those things right, then we find businesses that excel at the operate function, the generate function, and the allocate function. So they've got good market shares, or they've got dominant business models, they generate good returns on capital, and then they allocate that capital well. If you get all those three things right, then you've probably found yourself a compounder. What we also look for is things like lowest cost competitors, float businesses, intellectual property businesses. We look for rare assets, as someone talked about earlier on today. But in particular, we love owner managers. Now, Alex Wright earlier on talked about sort of turnaround businesses and new management coming in. There are investors that do a good job of that. To be honest with you, that isn't us. What we absolutely love is finding an owner manager who's aligned with us in his ownership of the business, that cares about the business, knows the business inside out, that we can effectively entrust that capital to. So back to our Leicester City portfolio. This is what we talked about 3 years ago, and what we were really referring to is, will a team of reasonably priced special companies, players if you like, can they beat what were then the loved franchises at the time? So one of the slides we gave in that presentation was this one. The reason we picked effectively this, if you like, as our opposition is because these are companies that we loved some years before as well. So in 2010, we wrote a research piece called Better Get a Bucket, which was in reference to Buffett's comment in 2009 of when it's raining gold, reach for a bucket, not a thimble. Well, in 2009, 2010, 2011, Coke, Becton Dickinson, Unilever, we wrote about them, wonderful business, trading at great prices. The point is that by 2016, that wasn't the case anymore. They were still wonderful businesses, they were well run, but they were no longer trading at fantastic prices. So, you know, we don't dislike these businesses. We didn't dislike these businesses in 2016, but it was an interesting peer group to put ourselves up against in terms of the shares that we chose. Should also say that those listed companies, those three, on average are up 40% since 2016. Okay? So the opposition team played well. So here's our portfolio as of 2016. Exor, General Motors, WWE, Sports Direct, Jardine Strategic, Suncor, Berkshire Hathaway, Disney, Apple, Wells Fargo, and JP Morgan. These weren't necessarily better businesses than those listed earlier or other franchises that were popular at the time, but we assessed they were mispriced against the quality of businesses and the likely future compounding they would give us. So our point then and now, and this was a point made earlier on this morning by David Harding, is that we just want to get up that compounding chart. And 2 points up that compounding chart makes a big difference. I think it was 10 times your money or 17 times your money he gave you. So starting prices matter. Nobody makes that point better than Charlie Munger. I think it's quite an interesting quote. Any damn fool can see that a horse carrying a light weight with a wonderful win rate and a good position, etc., is way more likely to win than one carrying a high weight and so on. But if you look at the odds, then it's a lot less clear which statistically does well. So 2010 was clear, great businesses at great prices. 2016, a lot less clear. And some of that is still very much true today. So how did our Leicester City portfolio do? That's our portfolio. Those are the returns that we made. Average is 81%, which is nice. But obviously that's somewhat inflated by WWE. If WWE had merely doubled, we'd have made 50%, which is still sensible. The franchise list was up 40, the S&P is up 35, all shares up 16. The reason we chose this title of the presentation at the time is because we'd written a research piece around that time on this very subject. And in that, we'd included a few more stocks. Melrose in the UK, which is a UK engineering company, was in that research piece, but it didn't make it onto our list of this slide pack presentation. But Melrose, for those of you that know it, has done quite well as well. So the point here isn't to be smug and say how clever we are. It's a 3-year period. You know, we could give it all back next week, as you all know. But it was an interesting test case to see how trying to pick special situation, good companies that are mispriced, how will they fare against the loved companies at the time. What we're really trying to do here is reflect effectively on what is our job. With some respect, but hopefully then they've left the building by now, to one or two of the presenters that came before, I don't think that our job is to be happy to underperform. I don't think that you should stand up and say, I'm a value investor, growth investors are doing well, I'm underperforming, isn't that great? I don't think that's good enough. I think we need to work hard to try and constantly adjust to the market environments we find ourselves in. I also don't think, again, no disrespect intended, that we should moan about the Fed. You know, we've had low interest rates for a long period of time. We all work hard. We can adjust to the environment we find ourselves in. So I think our job is to seek the traits of great compounding. It's to seek high return on invested capital, to seek moats, to seek growth, to seek owner managers. We've got lots and lots and lots of stocks around the world to choose from. We only need to find a few. But we need to look in unusual places. So we've looked in the airlines. We like Ryanair. We've looked in US banks in the last 3 or 4 years. I can tell you, marketing research on the US banks in the last 3 or 4 years has not been an easy task, nor a task we've been paid for, on the basis that no one's agreed with us. But we felt that there were franchises that were mispriced there. And ultimately, it just means you've got to dig, dig, and dig, and dig some more to keep finding the ideas that you want. So simply put, we think our job is to find great companies and buy them, but only buy them when they're priced like bad companies. So here's a new team for you for 2019, which I'm sure you'll all be interested to read. We've got 5 players that have stayed from the previous team. We've got 5 new players. To make it easy for you, our 5 new outfield players are Ryanair, JD Wetherspoon, Formula One, Fairfax Financial, and Lloyds. We've also got a new goalie, and I think I'd like to talk to you about our new goalie, if that's all right with you. How much time have I got? 9 minutes. Oh, excellent. We can go on for hours. OK. So the new goalie we've got is Charles Schwab. That would help, wouldn't it? OK, so the new goalie we've got is Charles Schwab. Hopefully quite a lot of you people in the audience will know the 2 other companies on this table, i.e. Hargreaves Lansdown and AJ Bell. You may distribute your funds through them, you may invest through them, you may even be lucky to own shares in them. These are fabulous companies, and these are really good examples of what Buffett calls a dream business. By that, we mean that they grow, they've got a high return on tangible capital, but they don't require any capital to grow. Now, the crux of why Buffett called those businesses dream businesses is because effectively you get paid twice for owning them. Every penny they make every single year in profit, you either get in a dividend or a share buyback, and then you still own the shares at the end of the year to get your share of the future growth of the business. So you get paid twice. And that's why those businesses are so powerful. But Mr. Market's no fool. And that's why Mr. Market puts those businesses on some pretty spectacular multiples. 45 times, and now 80 times for AJ Bell, post-trebling of the IPO only last November. Now, Charles Schwab is a similar business, but it's not quite the same. In terms of scale, you can see on the bottom table, it's an absolute gorilla in the space. So Hargreaves Lansdown is a big platform business in the UK, the biggest platform business in the UK. And you can see in terms of the assets under administration or management, Charles Schwab is just a Goliath in comparison. But its returns on equity are not so good. And it also, up until very recently, has needed capital to grow. So the stock market has valued this business more like a compounder than it has a dream business. Now, we'll go on to talk about some other parts of Charles Schwab in a minute, but the one thing I will just say is it's a much, much, much better business today than it was 15 years ago. So 15 years ago, 60% of Charles Schwab's revenues, sorry, I beg your pardon, I think it might be 20 years ago, I beg your pardon. 60% of Charles Schwab's revenues came from share trade dealing. Now, in terms of dealing transactions, it's 15%. The rest of it comes from its platform fees. So it's a dramatically different and more resilient business model. So let's look at some other parts from Charles Schwab. Charles Schwab is an undeniable industry leader. It's an industry leader in scale, it's an industry leader in pricing, it's an industry leader in growth, and it's an industry leader in product and technological innovation. It is also what we call a classic flywheel business. It's customer obsessed, and it's constantly reinvesting for the benefit of the customer. What we've also got in Charles Schwab is an aligned owner manager that came back to the business having left about 15 years ago. He owns 11% of the stock. And the chief executive and him work incredibly closely together in terms of future strategy. Now, the interesting bit about the flywheel reference is that we've seen this before. We haven't seen this before necessarily in Charles Schwab's next-door competitor in financial services. We've seen it in Costco. We've seen it in Ryanair. We've seen it in JD Wetherspoon. And that is the constant desire to reinvest for the benefit of your customer. And one thing stands out from those businesses, which we find very interesting, and that is the analysts ask questions of those businesses that basically says, you can't keep growing like this. And nearly every single one of those businesses outgrows expectations for longer and longer than expected, i.e. they beat the fade. And they beat the fade because they're giving the customer such a great deal. The other thing that's going on at Charles Schwab is the business is changing. But we don't think Mr. Market has really picked up on this yet. So about 15 years ago, Charles Schwab started to grow a new leg of its business, a bank. Now, it's not a bank to make subprime lending from. It's just a bank to allow its customers to put its cash on deposit with it as a bank rather than just leave it in its custody accounts. Now, anyone that knows anything about banking analysis will tell you that the one thing banks require is capital, and lots of it. Well, if you've got a business that's going to have deposits of $250 billion in 2019, you need friggin' a lot of capital, okay? So what we can then look at is why Charles Schwab, which is sort of like A.J. Bell and Hargreaves Lansdown at its core, platform business should be a high return on tangible capital business. Why did it have that 14% return we saw on the previous slide? Well, I'm telling you that return, that was a 5-year average. That return now is more like 19% because returns are rising. But the reason it had that return is because it's had to sit on so much capital. So what you can see on the second to last line down is that you can see the retained bank capital, and you can see that compared to the net income of the whole group in each individual year. So in all the years through to, say, 2017, this company's had to retain 100% of its net income in its business to make sure it had enough capital to grow the banking division. But it chose to grow that banking division. And without going into huge detail, all I will say is that they had a captive deposit market in their existing customers, and asking them to switch is why that the banking deposits grew 18% CAGR. What will happen from now on is that the bank deposits will grow at a slower rate, more in line with the rest of the assets of the business. Now that's quite interesting because what it shows you is that they only need to keep 65% of the net income of the business in the future. So they can pay out they need to keep 34% of the net income of the business in the future. They can pay out 65% of shareholders. So now they become a lot more like the dream businesses of A.J. Bell and Hargreaves Lansdown. So in terms of that's a short version of what is quite a complicated company. But in terms of what you win when you win, it's quite an interesting quote. Bearing in mind this company is already the market leader. You know, there's an interesting quote from the founder there that talks about this business potentially doubling its market share within the next 5 years. Now, we're not monitoring that at all. So prudently, we think Schwab can deliver a 10-year investor IRR of about 14%. How do we get to that? We grow the custody market by 5% per annum. We don't grow their market share in the way that the chief or that the founder suggests. We grow it 50% in 10 years. And we do that in the knowledge that the reinvestment flywheel passing on the unit cost to clients is something that drives growth. We assume a 70% payout ratio, which is obviously a significant increase from the past, but be clear, the management are already saying that that's what will happen and what they will do with it. And importantly, we assume no PE re-rating. So this growth is happening from revenue growth, from payout ratio, and from sensible allocation buying their shares back. Were this share to get re-rated to a PE of 20-something times to reflect that growth and that high return, then you're going to see much higher IRRs than we've given there. To finish, I would just say that I think we should all show our true colours in life and be honest in what you believe in. We're not typical value investors. And sometimes, as I said before, I think the sort of saying we're proud to underperform as value investors, we don't feel that's how we should behave. We are compounder owner-manager seeking investors, but ones that are mean and want to buy them at prices where no one else wants to buy them. The last thing I'll say, just for fun, is that when I told my 17-year-old son that I was going to present on investing, you can imagine how excited he was. When I told him I was going to present on football, he was significantly more upbeat. When I then told him I was going to present on Leicester City top, his face absolutely dropped. So as I said, it's really important to show your true colours. So that's what I'll do. I'll hold up my Crystal Palace shirt, which we wear every Saturday, and my son's nickname is Fluffy. So there we are. Thank you for your time.